Om Shri Guru Pyo Namaha. I welcome you all to the next video where we learn marginal costing. In this video, I will be talking only about concentrating more on problems from the examination point of view. I will just brush up with the theory part of marginal costing. So we will be discussing about the meaning of marginal costing, which is very important for 2 marks. Then they might ask for section B, features of marginal costing, absorption costing versus marginal costing. Then we will be discussing a very important part, that is break-even chart or break-even analysis, or commonly called as CVP analysis, cost volume profit analysis, and what are the elements of CVP analysis. Then meaning of marginal costing, absorption costing, then marginal costing statement, and objectives of CVP analysis. So these are important for section B if they ask any theory question. So what do you mean by marginal cost? According to Chartered Institute of Management Accountants, marginal cost is the amount at any given volume of output by which the aggregate costs are changed. The total cost will change if you increase the output by 1 unit, increase or decrease the output by 1 unit. So if there is any change in the cost, that change in the cost due to that change in unit is regarded as marginal cost. So marginal costing, it is the ascertainment of marginal cost. So in this technique, only variable costs are charged to operations. So the important part of marginal costing is we divide the total cost into 2 categories. So total cost will be divided into 2 categories. One is the variable cost and another one is the fixed cost. Since you cannot do much about fixed cost, you will not take it for the purpose of decision making. So we concentrate more on variable cost because this is in our hands. So that part of cost which can be controlled will be concentrated more in case of marginal costing. So marginal costing, we classify the costs into fixed cost and variable cost. The fixed cost, which is which cannot be controlled, will not be given much importance. But variable costs are charged to production. But fixed cost, later on it will be recovered from the contribution. Now the stock valuation is always done on the marginal cost. Selling price is also based on marginal cost plus contribution. Now profit is calculated by deducting the marginal cost and fixed cost from sales. Now CVP analysis is integral to the marginal costing. We have to do a proper cost volume profit analysis. Now profitability of product is based on the contribution made by each product or each department. Now absorption costing is the most conventional method of costing. Now here this slide explains about absorption costing and marginal costing, where which cost is included in case of absorption costing and which cost is excluded in case of marginal costing. Absorption costing includes both the cost, fixed cost and variable cost, because there is no distinction between fixed cost and variable cost. Whereas in case of marginal costing, it includes the variable cost. Later on, fixed costs are recovered. How cost per unit is calculated, how the valuation of stock is made. All these explains the differences between absorption costing and marginal costing. From university point of view, you need not study all these things. Just for knowledge sake, you can just check out the difference between absorption costing and marginal costing. So all of you are aware of the statement: sales less total cost is either you get profit or you get a loss. If your cost is more and sales is less, you get a loss. You suffer from losses, and if your cost is less and your sales is more, you get a profit. So this is the statement. Now here in case of marginal costing, we divide the total cost into two categories. One is the variable cost. Another one is fixed cost. Now variable cost is the cost which varies with the production. You incur variable cost only if you manufacture. Popular example is raw materials cost. The raw materials will be incurred only if you manufacture something. If you don't manufacture, that cost will not be incurred. So that is variable cost, which varies. But fixed cost, now say for example rent of the factory building, these costs will not will not change whether you manufacture or not. Such costs are called as fixed cost. So for the purpose of managerial decision making as to fix the selling price, to increase the selling price or to decrease the selling price, we require some costing statement. So these statements, the marginal costing statement, will be utilized by the managers to decide on the selling price. So this divided into variable cost and fixed cost. So we prepare a statement called as marginal costing statement. Marginal costing statement. This is the format I will be writing. So where you normally give two columns if the number of units is known. So this will be the particulars column. Now if you know the number of units, how many units were manufactured, then you can calculate cost per unit, and this will be the total cost. Alright, so we start with sales. From sales, if you subtract variable cost, from sales if you subtract variable cost, you get contribution. From contribution, if you subtract fixed cost, then you get profit or loss. If your contribution is more and your fixed cost is less, you get profit. If your contribution is less and your fixed cost is more, then you get a loss. If your contribution is equal to fixed cost, then that is called as break-even point, which we will discuss later on. So this is your popular marginal costing statement which you need to memorize. See, the marginal costing is all about memorizing the different formulas. You just take all the formulas, use it in the problem, substitute, and then find out whatever is being asked in the question. Now, CVP analysis. What do you mean by cost volume profit analysis? Here we CVP analysis. Here we try to analyze cost, volume, profit analysis, where we try to analyze the cost and how much is your volume of production or sales, and then what is your profit. So cost, sales and profit is what you're going to analyze over here. Now why do you have to do all these things? It helps us to forecast how much profit you're going to earn. It helps you to prepare flexible budgets, a statement. In advance you can prepare and check what is the position of your company. It helps in evaluating the performance of your organization, especially for controlling your organization. To fix your price, it helps you to fix the selling price of your product. It helps in taking the managerial decisions in the organization. So all these are the different objectives of CVP analysis. So the elements of CVP analysis is normally where we talk about cost, sales and your profit. So the popular term used in CVP analysis is First, we analyze the the ratio between your profit and volume. We try to analyze the relationship between profit and volume. So profit and volume, also called as PV. So the ratio between the profit and volume is called as PV ratio. So PV ratio is calculated using the formula profit divided by sales into 100 if you want the answer in percentage, excuse me. So now profit, we don't talk about the final profit. If you look at your marginal costing statement, your marginal costing statement is sales minus variable cost is contribution. We talk about contribution over here. When we talk about profit, we are not talking about the profit which we get after subtracting the fixed cost. We are talking about the contribution. So profit will be substituted by C divided by volume means sales into 100. So your formula itself, the name of the formula only will tell you what is the actual formula. So profit volume ratio is PV ratio. PV meaning profit divided by volume. Profit means we don't talk about the actual final profit, we talk about contribution. Volume means sales, C by S into 100. So this is your PV ratio formula. So there can be other formula also, depending on the information given in the question, you will use the other formula. So what is the other formula? The other formula is PV ratio is equal to change in profit divided by change in sales. So this is also called as PV ratio. So when the information is given with respect to sales of 2 years or profit of 2 years, in that situation we will be using this formula, change in profit divided by change in sales. Now coming to the next formula, break-even point. Now what do you mean by break-even point? Break-even point is the point when fixed cost equals contribution. Now say for example your popular marginal costing statement, sales less variable cost is contribution, less fixed cost is profit or loss. Supposingly your sales is 10,000 rupees, your variable cost is 2,000 rupees and your contribution is 8,000, 10,000 minus 2,000. Supposingly your fixed cost is also 8,000, then your profit or loss will be nil. This situation is called as break-even point. Now break-even point can be ascertained in units. It can be ascertained in units or it can be ascertained in rupees. If you are ascertaining break-even point in units, the formula will be fixed cost divided by contribution per unit. So you will get the answer in units. Now if it is in rupees, your one formula is whatever you get in units into selling price per unit. Say break-even point in rupees is equal to fixed cost divided by contribution per unit into selling price per unit. You get break-even point in rupees, or other formula is fixed cost divided by PV ratio. This is also another formula to find out break-even point in rupees. Now the next one is sales to earn desired profit. Now say for example, if you have to calculate what is the sales you make to get this desired profit, they would have given you desired profit, you should find out sales, or they'll give you sales, you should find out desired profit. Any combination using this formula you can substitute and then find out either sales or desired profit. So you should know sales, then you can find out the desired profit. If you know the desired profit, you can find out how much sales you can make. That also you can find out in units and you can find out in rupees. If you want to find out sales in units, then the formula is fixed cost plus desired profit divided by contribution per unit. So this is the formula we use. So if you have to find out in rupees, same like break-even point into selling price per unit. So what is the formula for sales in rupees is equal to fixed cost plus desired profit divided by contribution per unit into selling price per unit. Or depending on the information given in the question, if you don't know selling price per unit, you will take fixed cost plus desired profit divided by PV ratio. Divided by PV ratio. This is not contribution per unit. This is PV ratio. So if you divide by PV ratio, you will get sales in rupees. So depending on the information, if they have given sales, then you substitute fixed cost plus this will be question mark or X divided by CPU, cross multiply, find out desired profit. If they have given desired profit, then fixed cost plus take that desired profit given divided by contribution per unit, you will get sales in units. So let's quickly revise the formulas. Later on you can take a screenshot of it. So the first formula we discussed was PV ratio. So PV ratio is profit volume ratio, profit divided by V into 100, or P meaning in marginal costing statement it is C divided by S into 100. This is your PV ratio. Or contribution. What is the formula for contribution? Fixed cost plus profit divided by sales into 100. If you do marginal costing statement in reverse, so fixed cost plus profit will be your contribution. So divided by sales into 100 is also your PV ratio. Now the next one is break-even point. Break-even point in units. Break-even point in units, the formula was fixed cost divided by contribution per unit. If you want break-even point in rupees, then the formula was fixed cost divided by contribution per unit into selling price per unit, or fixed cost divided by PV ratio. This was the formula for break-even point. Then we understood the formula for sales to earn desired profit. That also we study in units. If you want sales in units, the formula is fixed cost plus desired profit divided by contribution per unit. Or if you want sales in rupees, then fixed cost plus desired profit divided by contribution per unit into selling price per unit, or fixed cost plus desired profit divided by PV ratio. So this is sales to earn desired profit. Then the last term, which is very important from your examination point of view, margin of safety. Margin of safety is equal to how safe you are with respect to your sales. Now break-even sales is the point where you don't get any profit or loss. If you go below break-even sales, you get a loss. If you go below break-even sales, you get a loss. If you go above break-even sales, you get a profit. Now this profit region is called as, how safe you are, is called as margin of safety. So anything over and above your break-even sales is called as margin of safety. So what is margin of safety? Actual sales minus break-even sales. So remember, you will not be safe if your actual sales is lesser than break-even sales. Actual sales has to be more than break-even sales. Then it is called as margin of safety. So this is, you get margin of safety in units. If you want margin of safety in rupees, margin of safety in rupees, then profit divided by PV ratio. You can also multiply by selling price per unit. Whatever margin of safety you get in units, you get margin of safety in rupees. So, or profit divided by PV ratio. So these are the common formulas used in marginal costing. So kindly memorize all these formulas. Now there is a problem over here. Always when you're solving problems on marginal costing, first you check what all is given in the question, then check what is asked. So in the first question, you have to determine the amount of fixed expenses. So what should we find out? Fixed cost, question mark. What all they have given? They have given sales. How much is your sales? Sales is rupees 2,40,000. Then they have given direct materials, direct labor, variable overheads. So variable cost is the total of all the three given in the question, which is direct materials 80,000 plus direct labor 50,000 plus variable overheads 20,000. So total variable cost is 1,50,000. This is your total variable cost. Then they have given profit. They have given profit. How much is the profit? Profit is 50,000. So with this information, you have to find out how much is the variable cost. Sorry, how much is the fixed cost? This is the question. What is the fixed cost? So first, you have to write marginal costing statement. So with marginal costing statement done in statement form or done in equation form, anything is fine. Ultimately, you need to find out the answer. That is the uniqueness of cost accounting. In cost accounting, we don't have any fixed formats like how we do in financial accounting. So however, whatever information you want, as long as the information is accurate and right, you can prepare as and find out what is being asked. So marginal costing statement. I will not draw lines and consume the space. So let's write sales. How much is your sales given? Sales given is 2,40,000. This is the sales given in the question. Less variable cost. Variable cost, we found out the variable cost total of all the three. So variable cost is 1,50,000. From sales, if you subtract variable cost, what will you get? You will get contribution. How much is the contribution? Contribution is 90,000. 2,40,000 minus 1,50,000. 90,000 is the contribution. From contribution, you have to subtract fixed cost. You have to find out how much is the fixed cost. And when you subtract, they have only given there is no loss, there is a profit. How much is the profit? Profit is 50,000 given in the question. So you know this contribution, you know profit of 50,000, fixed cost will be balancing figure. So 90 minus 50, fixed cost is 40,000. So solution, rather answer. What is the question? They have asked fixed cost. Fixed cost is equal to rupees 50,000. So rupees 40,000. This is the answer for the first question. Let's do the third problem. Now what is the problem? They have given total fixed cost. Total fixed cost is rupees 12,000. Then they have given, this is your total fixed cost. Then they have given selling price per unit. Then they have given variable cost per unit. Now this one I will do it in the equation form. Now they have asked you to calculate contribution. Now how much is the contribution? What is the marginal costing statement? Sales minus variable cost is contribution. So contribution is equal to sales minus variable cost. How much is the sales given in the question? 12 per unit. 12 minus how much is the variable cost given in the question? 9 per unit. 9 per unit. So if you subtract, you will get rupees 3 per unit. This is your contribution. Contribution per unit is rupees 3 per unit. Then they have asked you to calculate PV ratio. So PV ratio what is the formula? C by S into 100. How much is your contribution? We found out 3 divided by how much is your selling price per unit given in the question? 12. 3 by 12 into 100. So your PV ratio is 3 divided by 12 into 100. So your PV ratio is 25% or 0.25 if you don't multiply by 100. So this is your PV ratio. Next they have asked break-even point in units and in rupees. Now first we will do break-even point in units. Break-even points in units is equal to fixed cost divided by contribution per unit. How much is your fixed cost? Your fixed cost is, they have given the question, 12,000 divided by contribution we have found out, divided by 3. So your break-even point in units is 4,000 units. This is break-even point in units. Now if you have to find out break-even point in rupees, either you can take break-even point in units into selling price per unit, which is you found out 4,000 units is the break-even point, into your selling price per unit is rupees 12. So your break-even point in rupees is rupees 48,000. Alright, there is one more formula in rupees. What is that? Fixed cost divided by PV ratio. How much is your fixed cost? Your fixed cost is 12,000. and your PV ratio is 0.25. So 12,000 divided by 0.25, you get rupees 48,000. Whatever formula you use, you should get the same answer. 48,000 is the break-even point in rupees as per your break-even statement. Alright, now you can verify whether you have done is right or not. This is just required for understanding purpose. You need not do it in exam. So if you have to verify, now how much is your selling price per unit? Selling price per unit is rupees 12. Now how much is your break-even sales in units? 4,000. In rupees it is 48,000. So 4 into 4,000. There's no space. I'll do verification over here. I'll use this also. We are doing verification of break-even point. Now marginal costing statement we do sales. Now your number of units break-even sales is 4,000, which we found out over here. 4,000 into selling price per unit is 12. So 4,000 into 12, you get 48,000 as sales less variable cost. Variable number of units is 4,000. Variable cost per unit is rupees 9. 9 fours are 36. 36,000 is your variable cost. 48,000 minus 36,000, 12,000. This is your contribution. And look at your fixed cost. How much is your fixed cost? Fixed cost is also 12,000. Your contribution is equal to fixed cost. So whatever you've calculated is right. So this is just for verification purpose. We just see whether we've calculated right or wrong. Now the next question is, what will be the amount of sales if the desired to earn a profit of 6,000 and 15,000? So we are doing problem number 3. Now what will be the sales if it is desired to earn a profit of rupees 6,000? So if the profit is desired profit desired is rupees 6,000. So what is the formula? You can find out sales, how much sales you will earn in units, or you can also find out sales in rupees. If you have to find out sales in units, what is the formula? Fixed cost plus desired profit divided by contribution per unit. Now, how much is your fixed cost given in the question? 12,000. How much is your desired profit? 6,000. Divided by how much is your contribution per unit? Your selling price is 12 minus 9. So 3 rupees is the contribution per unit. So 18,000 divided by 3. So this is 18,000 divided by 3. So you get 6,000 units. So if you manufacture 6,000 units, if you make a sales of 6,000 units, you will get a desired profit of rupees 6,000. Let's verify. Now you can also do this in rupees. What is the formula if you want to do this sales? So before verification, let me do sales in rupees. So what is the formula? Fixed cost plus desired profit divided by PV ratio or selling price per unit. So how much is your fixed cost? 12,000. How much is your desired profit? 6,000. How much is your PV ratio? 0.25. So 18,000 divided by 0.25. So you get a desired profit of 72,000 rupees. So this is your sales. So let's check your let's do verification. I told you verification is not required. This is just for understanding purpose. So sales. How much is the sales in rupees? Directly I will take 72,000 less variable cost. We know variable cost per unit. How much is the variable cost per unit? Variable cost per unit is rupees 9. How many units? 6,000 units into 6,000. 9 6 are 54. So 54,000 is your variable cost. 72,000 minus 54,000. So you get 18,000. What is 18,000? Contribution less fixed cost. How much is the fixed cost they have given in the question? 12,000. So how much is your profit? 6,000. So this is your desired profit. So similarly, here they have given 6,000. In the next situation, you can take 15,000 and solve the problem. You will get a profit of 15,000 when you verify. So what is the units? Using this formula, you can directly substitute the profit given and find out, the desired profit. Now supposingly they've given desired profit. That time you will substitute it in desired profit and find out the sales. So it will be reverse. Substitute whatever is given in the question and then find out whatever is being asked. So let's find out. The desired profit is 15,000. So sales to earn desired profit. Sales to earn desired profit in units. What is the formula? Fixed cost plus desired profit divided by contribution per unit. So how much is the fixed cost? 12,000. How much is the desired profit? Now you require a desired profit of 15,000 divided by 3. So this is 27,000 divided by 3. So you have to manufacture 9,000 units to get a profit of 15,000 rupees. So if you want sales to earn desired profit in rupees. So one, you can take sales to earn desired profit in units into selling price per unit. So whatever you got in the previous one, sales to earn desired profit in units into selling price per unit. So how much is the sales you found out? You found out 9,000. How much is the selling price per unit given in the question? 12. So 9,000 into 12. 1,08,000. So if you make a sales of rupees 1,08,000, you will get a desired profit of 15,000. So there's one more formula for this. Fixed cost plus desired profit divided by PV ratio, which we found out. So how much is your fixed cost? 12,000. How much is your desired profit? 15,000 divided by how much is your PV ratio? 0.25. So you get rupees 1,08,000. So this is your sales to earn desired profit. So if you verify, we'll take sales. How much is the sales? 1,08,000 less variable cost. Variable cost per unit given in the question is 9 into how many units? 9,000. So 81,000. 1,08,000 minus 81,000. You get 27,000. 27,000 is the contribution less fixed cost given in the question, 12,000. So you get a profit of 15,000. That is given. So if you make a sales of, this is verification. If you make a profit of 15,000, you need to make a sales of 1,08,000. So you can do this, the other way around also. Supposingly they have given you profit of 15,000. For example, they have given you a profit of rupees. This is in rupees. They have given you a profit of rupees 15,000. Let's take this, this formula. We'll take this formula. So what is the formula? The formula is sales to earn desired profit is equal to fixed cost plus desired profit divided by PV ratio. Supposingly they have given desired profit of 15,000. So how much is the sales? We'll find out how much is the sales. So fixed cost is 12,000. How much is the desired profit? Desired profit is 15,000 divided by how much is the PV ratio? 0.25. So 12,000 plus 15,000 divided by 0.25. So sales is rupees 72,000. I'm sorry, I just found out sales only. I had to find out the other way around. Supposingly you know sales, you have to find out desired profit. So now you found out 1,08,000 is the sales. Supposingly they have given sales is 1,08,000. Sales is rupees 1,08,000. How much is the desired profit? How much is the desired profit? So we take the same formula. Sales is 1,08,000 is equal to fixed cost is 12,000 plus you don't know the desired profit divided by 0.25. So you do cross multiply. So 12,000 plus desired profit is equal to 1,08,000 into 0.25, which is 27,000. Desired profit is equal to 27,000 minus 12,000, which is 15,000. So either way around, you can find out if sales is given, you will find out desired profit. If desired profit is given, you can find out sales. So depending on the information given in the question and depending on what they have asked, you can find out sales and desired profit. So if we have to solve problem number 5, they have given sales. Sales is 4,000 units at rupees 10 per unit. So total sales is how much? 4,000 into rupees 10, that is rupees 40,000 is total sales in rupees. Now break-even point is 1,500 units. Fixed cost is 3,000. What is the amount of variable cost and profit? So here we take the formula for break-even point. Break-even point, what is the formula? Fixed cost divided by contribution per unit. Now what is the information they have given? They have given fixed cost is rupees 3,000. Fixed cost is known. Fixed cost is 3,000. Then they have also given break-even point in units. Break-even point in units to be 1,500 units. So they have given break-even point in units. Then you have to find out variable cost. Let's find out variable cost later on. First we use this formula and find out how much is the contribution per unit. So break-even point in units is known. So how much is the break-even point in units? 1500 is equal to fixed cost also we know 3000 divided by contribution per unit. So let's send this there and bring this down here mathematically. So therefore contribution per unit is equal to 3000 divided by 1500. So contribution per unit is rupees 2. 2 rupees per unit. Now you know the statement, sales minus variable cost is contribution. Now they have given in the question selling price per unit is 10 and contribution we found out to be 2. So how much is the variable cost? The balancing figure, which is 8. So balancing figure 8 is your variable cost per unit. And how much is the profit? So once you find out contribution, you can easily find out the profit using the statement because you know variable cost. So how much is the sales? Sales is 10 rupees per unit. So 10 into how many units they have given? They have given 4000. So your sales is 40,000. Sales is 4000 units into 10. So your sales is rupees 40,000 less variable cost. Number of units 4000. Variable cost per unit 8. 8 fours are 32. 32,000 is your variable cost. So how much is your contribution? Contribution is 8,000. How much is your fixed cost? Less fixed cost. Fixed cost given in the question is 3,000. So 5,000 is your profit. 5,000 is your total profit in rupees. So like this, using the different formulas, you can find out whatever is being asked in the question. I thank everyone for watching this video. I hope you understand whatever I've explained. If you've not understood, watch the video again and again. I'm sure you will understand all the points given in marginal costing, and very important table, the chart of marginal costing statement and various formulas, and then you find out whatever being asked in the question. Thank you once again for watching the video.